The coronavirus casts a worldwide shadow and fear stalks the markets. Welcome to Bloomberg Wall Street Week. I'm David Weston. Welcome back. This week, Bob Diamond, former Barclays CEO.
Always the challenge has been, how do we make the system and the banks safer and sounder while also promoting jobs and economic growth, meaning getting risk, getting lending into the economy.
And Atlas Merchant Capital founding partner. And Rick Reeder,
the credit markets today are challenging.
BlackRock's chief investment officer of global fixed income.
Liquidity down the credit spectrum is really, really tough. It is, we're all in, we're all out, and you can't trade that much.
And our special guest, Afsani Beshlas of Rock Creek Group. One story dominated Wall Street this week, and the business world, and the world itself. The coronavirus made its presence known even as it spread in ways detected and undetected, and the markets reacted violently, raising for some the question whether we're on the brink of another 2008 Great Recession, something Bloomberg Wall Street Week contributor Larry Summers weighed in on.
Another way I like to think about it is we're at a moment like where we were after Bear Stearns. That wasn't yet where we were after Lehman, but it was a pretty critical moment. And in retrospect, the time was largely wasted. And it would have been better if we had acted much more promptly. I don't think there is time to lose.
To help us sort out the reaction from the overreaction, we convene now our Wall Street Week Roundtable with Bob Diamond of Atlas Merchant Capital. Bob, of course, was the CEO of Barclays in the aftermath of the great financial crisis. And Rick Reeder of BlackRock, where he is Chief Investment Officer for Global Fixed Income. But he's not just a bond guy. He also is lead portfolio manager for BlackRock's multi-sector fund. So, Rick, Bob, welcome. Good to have you here.
Good to be here.
Bob, let me start with you. I think you took over Barclays in 2010 or so. So just as we were getting into the great financial crisis, what are the differences and similarities? I mean, Larry was careful in saying we're not yet to Lehman, but we may be at Bear Stearns.
I mean, there's similarities in terms of fear, but I think there are more differences. I mean, 2008 was a banking crisis. It was a liquidity crisis. It was a solvency for many institutions in financial services. And you know, particularly in the U.S. today, I don't think we could have a stronger banking system from capital levels and all the way through. And I think right now, obviously, it's a health crisis, number one. But in terms of the impact in the economy, my sense is that we are dramatically underestimating the impact in the near term in terms of the economy. And we may be overestimating the medium to long term, and that's very dependent on any resolution to the health crisis. I think secondly, while this isn't I don't think anyone would think of this as a banking crisis. One of the things we're all trying to figure out is how can the banks be part of the solution? They're definitely not part of the problem. And then lastly, I'd say, David, is I think, you know, when I look at the fault points, if I look down the road, I can easily envision a significant bounce in the equity markets because you know, I think the near-term impact on the economy could potentially unwind over time. But I think when you look at the low end of the U.S. dollar corporate credit market, I think that may be more permanent in terms of loss of value.
So, Rick, I wonder if one difference might be not very advantageous, and that is this. We had a level of cooperation, even across the aisle in 2008, and between fiscal and monetary authorities, that we seem to lack right now. People say we should be coordinated. It doesn't feel very coordinated what the government's doing.
Yeah, I mean, I think that's right. I mean, first of all, I would say one thing, that crises tend to bring people together, and so I think you'll see a bit more of that. But you're right, heretofore, you haven't really seen that. Listen, I think, you know, people like to, say in the markets, we like to grasp on the history because it gives us a pretty good playbook for how to think about this going forward. But, you know, it's interesting. Every time you have one of these disruptions, it's different than the one before. And they're usually, the reason why they're so potent in terms of how they hit the markets is you can't really go back and say, how did this play out before? The things that are significant are, I mean, this is an exogenous shock of significant proportion. Listen, we've never seen this before. We have people working in different offices. What is liquidity? How do people interface with one another? And that is really uncertain. So, you know, we've got to work through that part of it. But I think what Bob said is right. It's not a leverage problem per se. And the other thing that I think is significant about this one, and part of why we'll talk about you need that coordination, you need fiscal policy. The markets are not going to stabilize until you have something tangible from a fiscal policy point of view. Listen, the economy up to this point, and it's different regionally. Europe was still, I would argue, moribund in terms of growth, but the U.S. economy was actually surprisingly this late in whatever business cycle there is, was particularly strong. You look at hiring, you look at where we were from a housing point of view. Retail sales was good, and even manufacturing was doing okay in a secular decline. Now it's like, how do you get from here to there, and how do you get to the other side? Listen, I'm more enthusiastic about, I agree with Bob said, there's going to be some permanent tail to it, particularly in the credit markets. But this is something, we've got to bridge what is a really deep slowdown in the economy. And you have some sense that particularly Asia, particularly China and the U.S., there is some real vibrancy of those economies. We just got to bridge from here to there, and that is uncertain how we get there.
Bob, are you worried that the markets are not responding in ways you might have expected? We had last week the Fed cut 50 basis points. Market went down. They didn't like it at all. This week we had the Fed step up on liquidity and inject liquidity. Initially they reacted, and then they came off again. Are you worried that maybe the buttons that we're pushing are not getting the reaction we would expect?
Yes and no. So I think it's a tale of two sides. I completely agree with what Rick said, is what we need more than anything right now, if we're correct that the near-term impact on the economy is going to be severe, we need fiscal stimulus, and particularly in Europe. Having said that, I think what the ECB and the Bank of England have done in terms of providing liquidity, making sure banks have money to lend, particularly in Europe, where the banks are nowhere near as healthy as they are in the U.S., more asset acquisition programs, and in the case of the UK, both Governor Carney and incoming Governor Bailey have reduced one of the buffers so that banks have more capital to lend to small businesses. And I compare and contrast that to 2008 when President of the ECB, Trichet, raised rates, and the Governor of the Bank of England, Mervyn King, was focused much more on moral hazard. And I think the U.S., under the Bernanke moves in TARP, really stole a march at that time. So I do think, although I would like to see all of the central banks come out in a little bit more coordination, but I must say the actions taken by the Fed around the stimulus in the repo market and what's been going on in Europe, in the UK, I think are very strong moves.
But Rick, if it does require fiscal, where is the fiscal at this point? Because we don't seem to have any agreement in Washington. We have, again, Madame Lagarde saying we need some fiscal help over here in Europe, and Germany says, well, maybe, we'll see.
You know, there needs to be, I mean, one of the things that happens is you need to take out the bazooka in terms of how you go at this from a fiscal point of view. And by the way, a lot of these dynamics, if you spend the money, there are tangential benefits you get from it. So if we spend a tremendous amount of money on things like healthcare, you actually make discoveries in other places. That money actually, there's a multiplier effect that gets into CapEx and R&D, et cetera. We need to spend it. We need to take out that bazooka, and we need to do things around state and local government funding, et cetera. Where is it is hard to say. I mean, Europe's more difficult because of politics, because of some cultural dynamics around it. It needs to be bigger. What Italy did, 1% of GDP is a good number. And, you know, if you think about it, if the U.S. put 1% of GDP or more into this, that is where you start to get some velocity. That's where you start to get the real attention of the markets.
Bob, is it more important that you spend the 1%, or is it more important where you spend the 1%? I mean, if you had that discretion right now in the United States, where would you put the money?
So I think it's the right question. I completely endorse what Rick said, is we need a bazooka. And I also endorse it's much harder in Europe because of the lack of leadership in many of the key countries and the lack of leadership of Europe as a whole. But they have been really lagging in fiscal stimulus. But if it could be aimed, I would say, number one, those families that are most impacted, particularly, you know, single income families or dual working families or low income families who have the kids all of a sudden home from school right now. I think secondly, you know, healthcare. And making sure that we're doing everything we can possibly do to focus on the real issue here, which is the healthcare issue around coronavirus. And then there's other select places. I think we're going to see real weaknesses in some of the U.S. life insurance companies because of lower rates, widening credit spreads. We're clearly going to see challenges in the travel industry, hotels, aircraft, air flight. So I do think it should be targeted, David. But I like the way Rick phrased it, which is we need a bazooka.
Oh, so that sounds encouraging. You spent a fair amount of time in Washington. You talked to these folks in the administration. Do they get it? Do you think they're moving in the right direction?
Yeah, I mean, I think so. I think they're, yes, I think so. I think they're generally addressing some of the issues or talking about some of the issues. But I think you need to have a 7 or 8 step plan, and it needs to be pragmatic, diversified, and thoughtful about where it goes. There are things, a lot of what's going to happen are supply chain disruptions. That you need to get at liquidity in that. You need to get at transportation. And you think about what's going to happen now is people like to, there's some things, nobody's going to have a second dinner because they missed dinner. Right. But if you didn't get to go on your trip that you were going to make in March or April, gosh, you know what, I'm still going to try and go on that trip. You'll start to see that take place, but you need to kickstart that and get that fiscal. And listen, people are skeptical, and rightly so, I guess, about do you get Congress behind it? It's very difficult. Listen, a lot of these initiatives, the way Bob said, is right. If you a broad healthcare initiative, a broad initiative to help small business around supply chain disruption, gosh, that's pretty hard to vote against. Yeah. And so I'm more, think about, like Bob was saying, you go back to TARP or you go back to some of these initiatives, you got everybody together and it happens. And we got to just get the ball rolling there.
Okay, we are going to be back with our contributors Bob Diamond and Rick Reeder. Coming up, can the central banks save us again?
This has got to get to the fiscal side. The only way you're going to get velocity in the system, you need to get innovation, you need to get equity investment, and fiscal will do that.
This is Wall Street Week.
We decided on a comprehensive package of monetary policy measures. Together with the substantial monetary policy stimulus already in place, these measures will support liquidity and funding conditions for households, businesses, and banks.
ECB President Christine Lagarde is in the middle of a full-blown crisis just 4 months into her job, with investors and businesses counting on her to avoid the worst of the economic damage to come from the coronavirus. So she announced a stimulus package this week, including 120 billion euros in quantitative easing over the rest of the year and ramping up liquidity and lending capacity, but leaving rates where they were. In this week's Contributors Take, Stephanie Flanders, Bloomberg's senior executive editor for economics, takes us through the highs and the lows.
Christine Lagarde was very calm and deliberate in her press conference, which was a very unusual one to look at because the room was half empty. I think most of the reporters who were normally there had either not been able to travel to Frankfurt or were working from home and were submitting many of their questions online. But the president of the European Central Bank announced what she called a surgical, comprehensive set of measures to help the Eurozone economy through the impact of the coronavirus. There was a big new long-term lending program for banks, ideally aimed at them helping small and medium-sized businesses affected by the virus. Along with that, there was some word from the regulator side of the ECB that they were going to soften up some of their regulation of banks, perhaps to make those banks more relaxed about the impact that help for small and medium-sized businesses might have on their balance sheets. And you had an expansion of QE, of the bond purchasing program of the European Central Bank, which we think will be oriented towards corporate lending, corporate debt, not government bonds. What you clearly didn't see was the ECB follow the Fed and the Bank of England in cutting the key policy rate, which is already, though, at minus 0.5%. That was possibly because they didn't think that would make much difference. And I think also they would point to the fact that the interest rate on that new lending for banks was actually going to be below the policy rate. It's going to be a quarter of a point below 0.5. So in a sense, the rate has been cut for that kind of lending. It just hasn't been extended to the rest of the Eurozone economy. Investors we saw were not overwhelmed initially by what the ECB had announced, but actually Christine Lagarde herself said the ECB was not the only actor in this story. What was going to be crucial, she repeated, was a coordinated fiscal effort from Eurozone governments to confront this crisis. And I think we've seen that generally, the idea that we have to see not just that the grown-ups are in charge, if you like, but that they're really on top of the kind of micro measures and expenditures that are going to be needed to help cushion the blow of this crisis. We've seen that a bit from Italy. The UK had the good luck this week to have a budget scheduled for this week, so we've seen a lot of quite decisive fiscal action from the UK. From other governments, and specifically from Germany, not so much.
That was a contributor's take from Bloomberg's Stephanie Flanders. We are back now with Bob Diamond and Rick Reeder for more of our roundtable discussion. So, Rick, this was not a bazooka, the word you used, or not shock and awe, some people were doing.
Right.
Is it enough?
So I think we're beyond the idea of monetary policy comes to save the day. I mean, I think people compare this to the 80s or 90s when interest rates were significantly higher. When you move rate down, you can have a real effect. Interest rates are not symmetric when you reach the lower bound. When you get to zero, you hurt pension funds, insurance companies, individuals when you get to negative interest rates. So what Christine Lagarde did, there were some benefits there. The TLTRO was good. You're getting at targeted lending, which I think is a big deal. Listen, I think what she said is right. This has got to get to the fiscal side. This has got to get, the only way you're going to get velocity in the system, you need to get innovation, you need to get equity investment, and fiscal will do that.
So, Bob, you worked over in London. You know the London system very well. Did they show everybody the way it's supposed to be done this week? Because they had the Bank of England come up with a rate cut and they brought out their budget at the same time. It seemed to be quite coordinated.
I thought that the response from the Bank of England and the joint presentation from Governor Carney and Governor-elect Bailey was very thoughtful, very effective. I think it will be very effective. And I think both allowing one of the buffers to be removed from the banks so that they can get more lending into the real economy. I thought their liquidity measures, and if you think back to the financial crisis in 2008, those types of things weren't done at that time. So I think it is helpful. But I'll come back to the point Rick and I have been making, and now Christine Lagarde. We need fiscal stimulus as well.
What about the backing off on some of the reserve requirements of the banks? Because the Bank of England also did that. There's talk about that here as well. I mean, everybody thinks it was a good thing in 2008 what we did, make the banks stronger. We need them right now. But should we be backing off some for the time being?
Yeah, I mean, the regulatory dynamic is really significant. You think about what happened in the off-the-run Treasury market. I've never seen that before. The bid-ask spread in some of the off-the-run Treasuries was multiple points. That is a function of the banking system getting gummed up. You look at companies that are drawn on their bank lines, et cetera. When the banks don't have the ability to get in there, you need to do that. And by the way, it can be in short-term nature. You don't need to do permanent change, but you need to bridge the dynamic where you're getting more liquidity in the system and you're getting a better functioning environment. Some regulatory relief would be really helpful.
Is liquidity more important than actually the interest rate right at the moment? For example, for the Fed, are they better off really just injecting dollars into the system?
100%. And I think my opinion, just one of many opinions, is we used a bullet we didn't need to use with the rate cut here recently. I don't think that Governor Powell wants to go to negative interest rates. I don't think the UK wants to go to negative interest rates, and we used a bullet. What is really impressive is the bazooka they used in the repo markets. And, you know, one of the businesses that we've invested in, South Street Securities, is an independent broker-dealer, a non-bank holding company that does U.S. Treasury and mortgage repo. I see in that business the liquidity in the short end of the market has never been more robust I think, since 2008 and 2009 than it is now. As you'll recall, David, that during Dodd-Frank, there were changes to open market operations that the New York Fed could operate in. And a lot of that is being kind of taken back a little bit. And we're seeing much more activity from the Fed to ensure that liquidity in the repo markets. And I think, you know, for the functioning of the short end of the curve, I think it's enormously helpful. And I think you're spot on. I think that's been more important than the rate cut.
So the Fed did act this week to inject some liquidity, but was it enough?
Yes. I mean, that was
a bazooka.
It was awe-inspiring in terms of the amount they did. And listen, when you put that sort of liquidity in, you know, you were starting to see pressures in the last couple of days in the mortgage market. Listen, the mortgage market, when you bring interest rates down, mortgage rates are supposed to come down in a parallel way, if not more so. Mortgage rates actually were moving higher. Why was that the case? The system is gummed up. You needed to provide better funding, which happened. You need to provide better liquidity. And the other thing that I don't think people consider enough, when you put liquidity in the system, it takes pressure off the dollar. We operate in a global financial system. When you take pressure off the dollar, it makes it easier for emerging markets. It lets emerging markets go and enact policy on their own. That is a really big deal. Liquidity gets in the system, and it's got a real velocity to it, and they addressed it, and they had to do it. But you were seeing some cracks in the mechanism, and you can't buy other assets, you can't buy equities, you can't buy credit until the core asset, the risk-free rate, is solved.
Yeah. Okay, we're going to be back with our contributors. If you missed an episode of Bloomberg Wall Street Week, full episodes are now available on YouTube, the Bloomberg Terminal, and on Bloomberg.com. This is Wall Street Week. This is Wall Street Week. I'm David Weston. All of our contributors on Wall Street Week this week agreed on one thing. We need fiscal stimulus, not just monetary. The question is how much and when will we get it? Well, now President Trump is declaring a national emergency, and that may give us at least some of what people think we need. For more on that, we go now to our chief Washington correspondent. He is Kevin Cirilli. So, Kevin, will we get some form of fiscal stimulus out of a national emergency?
Yes. Look, I think that there's two quick things that I would note here. First and foremost is that by the president declaring a national emergency and invoking the Stafford Act, it allows him to have more cash on hand and more liquidity on hand, quite frankly, to work with FEMA to inject into local municipalities at the very local level where there is a hotspot of activity of the coronavirus outbreak. That takes some of the pressure off of Congress to deal with this from their ability so that they can focus more, and this is the second point I make, more on the economic stimulus component.
And that's the question, the economic stimulus. You'll remember back in 2008, 2009, we had TARP, and that really put an enormous amount of money at work. Are we going to get something on that order of magnitude out of Congress, and perhaps as important, when?
You know, what's fascinating about the conversation right now is that the timetable is moving very rapidly. Treasury Secretary Mnuchin and Speaker of the House Nancy Pelosi, David, as we've been reporting, have been working really round the clock. But the timing of when they're actually going to come up with something remains loose because, quite frankly, so many Americans are staying home from work.
At the same time, what about the politics of it, Kevin? Because it struck me that for once we might not have a partisan divide. It's not clear that some of the Republicans up on the Hill are agreed with the Republican White House on what exactly to do with fiscal stimulus.
Precisely. And in fact, as it relates to taxes, that in particular has some Republicans very uncertain as to whether or not they could get behind that. But on the issue of politics, this has completely upended the Democratic 2020 Democratic presidential race. We've seen states delay and postpone their primaries. And really, I think both campaigns, Sanders and Biden, are recalibrating as this continues to play itself out.
Which is a challenge for Senator Sanders, for the former vice president. At the same time, it must be a challenge for the White House right now. They must be a little bit nervous about a crisis right now as we go into a November election if President Trump doesn't come across well.
And as all outside strategists have put it to me, David, the best thing for the Trump administration to do right now is get this under control, provide free access to testing, get the confidence of the American people, get the confidence of the economy back on track, and then pivot back to politics.
How much are they focused on the public health aspect of this? A lot of people are questioning why we don't have more tests out. We heard from Dr. Fauci this week saying it's a failing, actually, that we can't test more people more quickly.
Precisely. And this is where the public-private partnership is really going to be a massive illustration of that. And the administration says that in the next week or so, that tests are going to dramatically increase.
And will they?
Well, we're going to have to find out, hopefully. Look, public-private partnership, the stakes have truthfully never been higher.
Yeah, no question. The question is on the public-private partnership, can the private sector really step up the way that we need them to? Okay, thank you so much to Kevin Cirilli. He, of course, is our chief Washington correspondent. Coming up, Saudi Arabia goes to oil price war with Russia.
So what happened this week was highly unusual. And when you couple that with everything else that we've been talking about, it is truly all-out war.
This is Wall Street Week. Welcome back from New York. This is Bloomberg Wall Street Week. I'm David Weston. The coronavirus didn't just hit stocks and bonds, it hit oil prices as well, as markets anticipated a demand shock emanating out of China, and then OPEC tried to do something about it, publicly calling out Russia for production cuts it hadn't agreed to. Russia declined, and Saudi Arabia declared a price war that took oil prices down the most since 2008. We're joined now by a Wall Street Week contributor who did her graduate work on energy at Oxford and worked at Shell before going on to the World Bank, Carlyle, and then founding her own firm, Rock Creek Group. She comes to us today from Washington, and that is Afsaneh Beschloss. Afsaneh, great to have you with us. Thanks for being with us. So give us a sense from your take. Just stick with Russia and Saudi Arabia right now. What happened?
It was all-out war. And normally with OPEC, when you have these kinds of statements, somebody backs off really quickly within 24 to 48 hours. So what happened this week was highly unusual. And when you couple that with everything else that we've been talking about today, it is truly all-out war. So it's not just an oil war. It's like an all-out war on the economy. And the amount of money that got taken out for oil producers with this shock, with oil prices going down to the 20s and now sort of hovering around the low 30s, has not really happened, as you said, for a very long time.
Afsaneh, who was shooting at whom in this war? Was it Russia shooting at Saudi Arabia shooting at Russia, or was Russia shooting at the United States?
So it was supposed to be both of them shooting at the United States, trying to kill the shale business in the U.S. once and for all. And it's interesting, given the timing they chose, two things I think are important. One, will this be the worst time in the U.S. economy that might lead actually some protection of our own shale industry, which might not have happened if they had done it at a different time? And two, it has caused a major falling out, at least to the eyes of the beholder, between two great autocrats in the world. So it is, not clear who's going to blink first. It seems like neither is going to blink. The other group that was the other country that was supposed to really get hurt was, of course, Iran, which already is in a very bad situation. But I think there's always been a subsidiary effort to kill that oil industry as well. But I think the main effort was to get the shale industry to basically kill over.
So Afsaneh is the expert. I loved listening to this. I think from someone who's not an expert in that area and outside watching this, you kind of have the impression that you can't make this stuff up. We have this crisis in the world right now around coronavirus, and we have this political game going on between Saudi Arabia and Russia with profound implications on economies around the world. You just can't make this stuff up.
What happens to the shale producers, Afsaneh, if it was targeted at them? I mean, you really see them under an awful lot of financial stress and strain right now. A lot of them were leveraged. You saw some of the yields, high yields, really blow out there. So what happens to the shale producers?
Exactly. So they already were over-leveraged, and I think this is a huge problem for them, and that is why what happens with some sort of assistance through credit markets to the biggest shale producers will be really key to keeping them up and alive. At the same time, I think, as Bob is saying, what is really interesting is why would Russia and Saudi Arabia do this at this time? The second thing that is very unusual at this time, by the way, is that normally when you have such a big oil price shock to the downside, you have people driving more, you have people using more energy, and you have emerging markets and oil importers actually have a big uptick in their stock or in their currency. Given the crisis that's going on, we're not seeing any of those. So it's not just the shale producers that are hurting, but it's really the global economy.
So I think when you think about credit, David, and I mentioned this earlier in the show, that the proliferation of credit since the crisis with lower interest rates, QE1, QE2, what we have seen is a doubling of the amount of leveraged loans outstanding today. It's something like 1.3 trillion. There's 4 times as much BBB, the lowest rated bonds out in the market. And I think we've been wondering what is the match that will kind of start this, and what's happening to the economy as a result of coronavirus might be that. And I think one of the fault lines is going to be in the energy sector, particularly the energy sector in the U.S. As Afsaneh said, that's where leverage is very high. And that's where the business prospects and the cash flows are dropping most quickly. So we happen to think that we're going to see quite lower values in below investment grade debt across U.S. dollar corporate market, but particularly in energy.
So normally when you have that, Bob, there's a shakeout. Bankruptcies, let's be frank, what happens. And then assets go up for sale.
Yeah.
Are the majors in a place to come in and buy some of that up, Bob?
I think what we're going to have to see is significant consolidation, and otherwise we're going to see a number of bankruptcies. But one of those two things is going to happen, and I do think that the majors are very, very healthy right now. So do they have the capacity from a capital structure point of view? Yes. Do they have the willingness? I'm not enough of an expert in that sector to know.
So Afsana, you are. What's going to happen?
Well, I think two things. One is that the other people that are getting hurt and will get hurt even more are people who lent to the shale industry. So there's not going to really be any silver lining for them. I agree that there will be consolidation. It may not necessarily be the big oil majors, because the oil majors, just before this happened, have been trying to diversify their sources of energy away from oil and gas and away from hydrocarbons into more renewable energy. So it will be really interesting as they weigh the cost of shale versus the cost of renewable energy, which way they go. But most of them are starting to call themselves energy companies versus oil and gas companies. So that's something interesting to watch.
So Afsana, you've been in the forefront of that move. You've been very outspoken about that. What effects might this oil price war, particularly if it continues for any period of time, have on that dynamic? Does that put off the date for people to invest in the renewables?
I actually think that process is sort of ongoing. You had 1.6 trillion go into renewables since 2016, another maybe 10 trillion going in over the next few years. And what is, I think the forces of renewable energy is one reason that we have seen as oil prices have gone down, they don't bounce back. You remember when we had the incident with the refinery in Saudi Arabia, oil prices went up, but then they really did go down pretty fast right after. The forces that are at play between the forces that climate change has created, as well as the geopolitical issues that we're seeing right now in front of us, as well as having had a really nice weather winter season, all of them are forcing the oil producers to really panic. So I think looking forward, it's going to be much less focus on oil and gas, and at least oil, and maybe more focus on natural gas, including local U.S. natural gas and shale gas, as well as renewables.
Bob, can we afford the United States to lose the shale industry? I mean, not to say we'd lose it altogether, but I mean, going back into history in 1986, then Vice President George Herbert Walker Bush went to the Saudis and said, you can't let the price go too low because you'll wipe out my domestic industry. We have President Trump just this week saying, you know what, low gas prices, that's a good thing. That's like a tax cut. He sort of likes it.
You know, I think Afsana brought up the right issue, which is, you know, the majors have the capital to take part in that, but they don't have the willingness for all the reasons that she spoke on so well. I think, secondly, you know, when you look at the impact of this on the high-yield bonds or the corporate bonds that support so many of those activities, the banks just don't have the capacity because of capital rules that were introduced post-2008 to really be part of the solution. So what we're going to need is we're going to need private capital, which is targeted for this area, or some kind of a government program. I doubt we're going to see a government program in this area, so it's really about private capital.
Okay, many thanks to Wall Street Week contributor Afsana Beschloss, coming to us from Washington. Bob Diamond, I'm delighted to say, will be staying with us. Coming up,
can tech help save us from the coronavirus?
So if you look at flu viruses and the flu shots that you get every fall, it's a matter of looking scientifically at what's going on, but also predictively at how that virus will evolve over the course of time.
This is Wall Street Week. This is Bloomberg Wall Street Week. I'm David Weston. The one thing everyone seems to agree on is the ultimate source of the market turmoil. It's that we don't know how or when the coronavirus crisis will end. Most immediately, we need a treatment such as the Gilead Ebola drug that they're trying out right now in Washington. But ultimately, it's a vaccine that the world needs, and that is going to take some time.
Although this is the fastest we have ever gone from a sequence of a virus to a trial, it still would not be any applicable to the epidemic unless we really wait about a year to a year and a half.
But 18 months seems an awfully long time to wait right now, which leads some to ask whether a combination of science and technology could get us there faster. Welcome now someone who's trying to do just that. Dave Turek is Vice President of Technical Computing, IBM Cognitive Systems, and he joins us now for a second opinion on what could be done about the coronavirus. So, Dave, welcome. It's good to have you here.
Thank you.
So explain to us exactly what's being done, what's IBM's role in this thing, how could we actually maybe get a vaccine a bit sooner?
So the largest supercomputer in the world is at Oak Ridge National Laboratory, constructed by IBM. And this system has a capability of merging concepts of artificial intelligence with standard mathematical representations of problems. So what we do is when we look at the possibilities of efficacious treatment for something like corona or looking for a virus, what you want to do is you want to follow a lot of different paths because you don't know which path will be the one that pays off. So in particular, at Oak Ridge, they've looked at 8,000 different compounds, and with a supercomputer, they've culled that down to 77 compounds in just 2 days. So those 77 compounds then go into a wet lab where they begin doing the experimentation on it to see if they work or not.
So give me a sense, normally from going that 8,000 to the 77, how long would it take if you weren't using a supercomputer and artificial intelligence?
Years.
Years?
Yeah. And it would cost a huge amount of money because you'd have to build up a wet lab to look at every one of those 8,000 compounds. Now, practically what you would do is you'd make a guess, you'd hope your guess was good, and then you would start down that path, but you'd have no real idea of whether you're getting close or not.
And Dave, how do you then wait for the wet lab portion of this to do combinations of those 77?
So the 77 are each looked at, and then you can, while the wet labs are being operated, you can look at early results from the wet lab experiments, and you can begin to do mathematical modeling speculatively about how those wet lab results might manifest themselves in a real live application. You can also begin to explore combinations of these things as well, as you said.
So how do you get from there to a vaccine? I mean, are you basically understanding the mechanism by which the virus works?
It's a variety of things done in concert. So you look at things sort of in our time, a second, a minute, a day. But a lot of the modeling goes on at extraordinarily small pieces of time, 10 to the minus 14, at atomic level, atomic kind of clock speed. And you begin to build up your understanding of the systems by operating, simulating things at every one of those time steps, then aggregating them up to clock time, where we're generally used to, and then looking at that over days, weeks, et cetera. Tremendous amount of compute power. That's just a molecule by itself. Then you look at it in concert with the disease, then you look at it in concert with the human organism, and you begin to look at the interplay of all these factors to understand what the probabilities are of having a successful event.
Has this ever been done before?
So yes, in fact, IBM worked with some of the previously emergent new strains of flu. The last H1N1 thing I think that came out of Mexico, we used our technology at that time to do some modeling of the evolutionary pathway of that. So if you look at flu viruses and the flu shots that you get every fall, it's a matter of looking scientifically at what's going on, but also predictively at how that virus will evolve over the course of time, and you take a shot at where the puck is going to be, and then you build your virus for that and hope for the best. So it's a complicated mathematical construct that you need to examine.
And how does the organization of this take place? Is this an IBM initiative? Is it an IBM in concert with the government? Tell me more about how that works.
The system that's deployed at Oak Ridge National Lab was a partnership between the Department of Energy and IBM to construct the computer to cover the vast array of scientific endeavors they pursue. This particular example is of a scientist working out of the University of Tennessee on the system in concert with the researchers at Oak Ridge National Lab. We provide just standard support for the operation of the computer at this stage. There are many other activities going on inside of IBM, of course, that will look over the course of time at different factors regarding how you manage pandemics, et cetera. But the Oak Ridge problem right now is really being driven out of the University of Tennessee and Oak Ridge.
So I won't hold you to this, because I'm sure there's no knowable answer to it. But in success, if it worked perfectly, could you take time off that 18 months, and if so, how much?
I think there are a couple of ways to look at this. One is, in the absence of the computer, you're basically throwing darts at a dartboard in the dark. And so you don't know if you're even close to the target. So what we've done is we've winnowed that down quite dramatically. So now the lights are on, you know where the dartboard is, you know what the darts are in your hand, and you can start taking a shot at it. That's a tremendous advantage for the scientists that are working on this. The 18-month is, a lot of it is human trials and so on. So it's not going to do so much to compress that time span. But what it has done is it's really accelerated the starting step. So instead of waiting for a year to come up, or 2 years or 3 years, with that set of 77, we've got it in a couple of days. That's a big step forward.
Who owns this who owns the IP in this?
So the IP is all being generated by the scientists involved. The Power 9 technology, which underscores the computer, is all IBM. The ownership of the system is Oak Ridge National Lab, as an agent for the Department of Energy.
Have you tried this for other medical applications besides viruses? You said you did it with the H1N1 out of Mexico. Are you trying it with other medical applications?
Yeah, we have a group called Watson Health inside of IBM that looks at the amalgamation of artificial intelligence techniques with technologies like Power 9 to bring that to bear on a variety of problems, whether it's cancer or other kinds of medical issues. The same technology, though, has been used in the industrial sector. It's used for fintech. It's used for the design of airplanes, cars, problems in computational chemistry. And one of the very rich areas is material science. Material science percolates through our economy. And the ability to understand how these different materials are working and how to invent new materials is a critical dimension to how you drive the economy forward. Same technology can be used for that.
It's really fascinating. Good luck on the coronavirus. I hope
Thank
it
you.
works for all of our sakes. Okay, many thanks now to Dave Turek of IBM. If you missed an episode of Bloomberg Wall Street Week, full episodes are now available on YouTube, the Bloomberg Terminal, and on Bloomberg.com. This is Wall Street Week. Welcome back to Bloomberg Wall Street Week. I'm David Weston. We've had a look back at the week that was on global Wall Street. Now it's time to look forward and talk about what we expect to be talking about next week. And we're, of course, back with Bob Diamond. So, Bob, one of the big issues, obviously, is the Fed. The Fed will have its decision next week. What do you expect? Do you have expectations for the Fed? They cut the 50 basis points last week. They did an infusion of some liquidity this week. What's left?
So the way we talked about it earlier is the rate cut. Some felt it was necessary, some felt it wasn't. But the bazooka, if we can call it, in the liquidity in the short end of the market, I think was effective, will continue to be effective. So let's see how that I think they're going to look back and see how that's impacted liquidity before they make the next decision. We're also just going to have more information, David, day to day to day on coronavirus. Yeah. And I think that's, we have to keep perspective. The real issue here is around coronavirus and the health issues. And as we talked earlier about the outsized impact it's having on low income and low income sector, but also small businesses.
We may have some indication, although we may not, of where we're heading on the fiscal side when you're talking about the low income people, because a lot of people are saying that's where we have to be targeting. Because you think about hourly employees who have to stay home and things like that, they're going to be hit pretty hard, pretty fast.
Yeah, it's been a very, very big change with schools closing across the board. The impact on families is significant.
At the same time, one of the questions is, what's the pattern with China? Because we're looking at China to some extent to say maybe we'll follow that. When does it peak? It seems to be coming down now a little bit already. And we get some China data coming out, things like retail sales.
What data are we getting from China?
That's always the question, and actually, it's a good point that if it's too good, then you don't believe it.
Yeah, exactly.
Right? Exactly.
But will the data next week cover the period of coronavirus in China?
It's the month of February, so certainly
we'll
it was hitting China by February, so we may get some indication, some hint about that. And also we get some sentiment sort of data out of the United States, because that's clearly key about exactly what's happening in consumer sentiment, sentiment overall in the United States, and how much is it really chilling, U.S. businesses and consumers in particular, because we've been so dependent upon the strength of the consumer for this economy.
Yeah. Interesting week.
Yeah, no, it will be an interesting week without
Every day is interesting right now.
Yeah, exactly right. But I come back to what you were talking about. I mean, one of the things I will be looking at is how many tests are we doing?
Yeah.
You know, are we ramping up the tests? Do we have a better sense? Because I think most people have a sense right now, more people have it than we know about.
Yes.
And it's exacerbated by the fact that people can be relatively asymptomatic for an extended period of time. So people could walk around with it and we don't know. And the more we can get our arms around just how bad is this problem.
Well, I think what you're saying is the more people feel that we actually have accurate numbers, accurate information, accurate testing, plenty of testing, they're going to feel more comfortable that we actually know how this is playing out. And I think that is getting better each day as well.
We also have Bank of Japan decisions coming out next week. Is Bank of Japan helpful at this point? I mean, they've been in a tough spot for some years now, frankly.
Well, you know, in terms of monetary policy, again, I think monetary policy is not what is necessary in Japan. It comes back to the same story we've talked about all day, which is fiscal stimulus. I don't expect that we're going to get that next week, but I think that's what people would be looking for.
You know, I talked to Larry Summers, the former Treasury Secretary, this week, and he said he thinks we are already in the same spot as Japan. People talk about the possible Japanification of Europe and the United States, that sort of low growth, low rates, negative rates existence that, as he says, is awfully hard to get out of. Do you think that's too soon to make that call? Are we stuck in that sort of quandary?
I would say it differently. I think, you know, Japan is far more severe in those measures than the U.S., but we've talked about this over the years. There is a point at which we have to get back to more normalized interest rates. Yeah. There is a point at which we need to get back to a more normalized curve. One of the things that we have to realize is, as we sit here today, a lot of the monetary stimulus that could have been used now has been used. We have almost zero interest rates. But more than that, if you go back to the end of 2017, the announcement of personal income tax cuts, corporate income tax cuts, and a significant spending bill, we used a lot of the fiscal stimulus then as well, which is implemented in early 2018. And as we sit here today, one of my worries is that we have less ammunition on the fiscal side than we would have had we not spent that earlier. One of the implications of that, David, is that, you know, the deficit prior to that was narrowing since the crisis. But since that stimulus, the deficit has been widening. And the estimates for 2020 are that our deficit will be $1 trillion. So we do have to keep in perspective that we don't have as much ammunition on the fiscal side as we could have had.
Yeah, when we talk about fiscal stimulus, we forget that we have already had a lot of fiscal stimulus.
We've had a lot of fiscal
already.
stimulus.
And we have the bill to prove it.
Yeah, we have the bill to prove it.
Exactly.
Yeah.
Okay. Thank you so much to Bob Diamond. This has been another edition of Bloomberg Wall Street Week. See you next week.